Hello, everyone. Welcome back to The Enlightened Investor. Here from Peoria Heights, Illinois, Mike Mahoney here and Joshua Luer. We're going to talk today about how to invest during the rising rate environment. And today's takeaways, we're going to talk about, did the Fed get it right today at the big FOMC meeting? This is the biggest change since 1994. We're going to talk about what the effect did quantitative easing have on the economy. We'll look at what happens if the Fed pushes rates higher. Can they continue to do that? They got some debt issues. And we're going to take a look at, lastly, what should you do as an investor in this environment? So first off, Mike, get you in here.
I know you're excited. We're talking about the Fed and interest rates and economics. This is right down your alley today.
So did the Fed get it right today, Mike, raising 75 basis points?
I don't know. I think they need to raise it higher as we talk pre-camera, but just to get back to the mean where we were. I mean, we've been this way, since pre or post 2008 when we started all this QE. Mm-hmm. I mean, you saw the 10-year was 5%, and what we look with 10-year right now is like 3.4. So I think we need room to go, but I'm not an economist, just an advisor, so we'll see.
Well, I think as an investor, what do you think the number one issue is right now?
Oh, sure.
Fed credibility, inflation. Right. So getting back that credibility is a big thing. So I think pushing rates higher. I think the Fed did the right thing, 75 basis points.
Yeah, I agree.
For sure.
Yeah, I'm with you.
We're at 1.5%. So getting back, Mike's a mean guy. He likes to get things back. Things will revert to the mean in your life, right? In your
they will.
World.
I mean, forget about the strategy or the valuation. I mean, you go long enough, you're going to get a reversion to the mean.
Okay, so next is we've been in
exciting.
So how do you invest in this environment, right?
Right.
So the next thing is what is this thing called quantitative easing? This lowering of interest rates. How long has it been going on, Mike? I think Japan started quantitative easing back in the early 2000s, but when did we start quantitative easing? 2008. So Mortgage crisis. Yeah, the Fed got scared, and here's a cartoon for the folks at home. Chomp, 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 overfeed the economy with quantitative easing and money supply, lowering interest rates. And then here on the right-hand side of the screen is what we're having now. Here's the Fed with a noose, a rope. Well, I was thinking about tightening, and people are freaking out like crazy. Right. So
recession pending.
Recession and stagflation and recession pending. So let's take a look at where we've been here. I got a slide here looking at short-run interest rates over time. This is the federal funds rate. This is the rate in which the Federal Reserve sets that banks can loan to other banks in short-term overnight loans. And you can see back in the 70s and 80s and 90s, really, you're looking at something on average of 7, 8%, right, Mike? But I have a couple arrows there. You can see there after the Great Recession and during the Great Recession, those black arrows on the right-hand side of that screen show when we had 4 cases of quantitative easing in the last 14 years. We had one in 2008, one in 2010, one in 2012, and then recently, after COVID, we had one in 2020. So you can see that we've really pushed down rates. How much lower can they go below zero?
Right. Yeah.
Right? Now,
negative. Yeah. When Europe had some negative rates, we just didn't get there here in the U.S. Right?
That's right. Europe did. And effectively, we have negative real interest rates, folks, but that's just another thing. And we were talking a little bit about what to do for, maybe some investors out there. What do you do for yield today? And again, here's a graph here of the long-run interest rates. This is a 10-year bond and how much it's yielding. And you can see over time, it's really taken a dive. And that's a lot of reasons. You've had a flood of foreign investment. I call it the Asian savings tsunami that's brought down the bonds. But look at those 4 arrows again, bringing down bond yields. And I don't know, Mike, what do you kind of, you always have a diversified portfolio, but what are you doing right now? A little more tips involved right now?
We're adding tips about 20% within an IRA because they're not tax inefficient. But also, you mentioned yield. The thing we don't want to do with fixed income is we're not going to seek yield through duration, going really long, because it doesn't, as we talked earlier, the yield curve is very flat, so it makes no sense to go very long at all. And if you're going to seek higher yield through credit risk, you're basically taking equity-like risk and not being rewarded in fixed income. So we're going to be investment grade and we're going to stay. We're building our ladders based off of the yield curve, which is abnormally flat right now. So we're keeping them very short.
Yeah, extremely.
And blending in some tips just.
Yep, very smart.
For the inflation protection.
Very smart. Folks, I wanted to have you, next thing I want to take a look at, a takeaway for you is where do we see interest rates heading? And obviously they're heading up. But here's a slide that looks at the CME Fed Watch tool. And we're looking at some hikes going forward by the Fed, quantitative tightening it's called. In July, we'll have a 75 basis points raise. In September, a 50 basis points raise. In November, a 50 basis points raise. And then lastly, we'll have our last Fed meeting on December 13th and 14th. And that's expected to raise about 25 basis points. So by the end of the year, you're looking at something like 3.5 to 3.75.
Still low.
It's still low.
Yeah.
Okay, so Mike, here's a question for you.
Okay.
What happens to investments and assets when they usually
raise interest?
Yeah,
right. They're kind of inverse, right? It's like the old seesaw. So yeah, we could see the market go. Obviously, we're seeing the market kind of start to have volatility because of rates. But the market's forward-looking. How much of that's not already booked in, right?
Very good. Very
it's
good.
like you're showing that they're already pretty much forecasting what they plan to do. So.
Yep.
We'll see how low we go, right?
Yep. And what I want to show you right before we get to like the investment part, I want to show you do Fed funds rate really change GDP? And this show is about the enlightened investor. We want to look at evidence-based investing and evidence-based economics. And here's an article from Sip and Zhang in 2020. The GDP, U.S. Treasury yield, and the federal funds rate, who follows whom, when, and why, from the Journal of Financial Economic Policy. And what they found really from 1997 to 2019 is that, yes, that federal funds rates do impact GDP growth about 63% of the time. And the reason that it's not 100% of the time is because you oftentimes have federal funds changes that are small, incremental 25 basis points. Whenever you see large basis point jumps, like today's 75 basis points, you're going to see an effect.
See an impact, right?
Yeah, so definitely. So here's a really amazing slide that I hope you can stick with here. This is a slide on can the Fed keep raising rates to 3.5%, folks? Is this possible? So what I have up here is the Fed is trapped potentially on debt limitation. The U.S. national debt's about $30 trillion. The U.S. GDP is about $23 trillion. Interest on the national debt right now is $343 billion, and the effective rate is about 1.43. So today, down below on the next little graph in the table, the Fed raised rates by 75 basis points. So the new effective interest rate for debt is about 2.18. The debt service goes up to $664 billion, which is about 2.82%, up from, what do we calculate, about 1.8?
1.8, right.
Yeah, so it's a full point increase. But if you go out until December, folks, look at this. You have a percent of GDP, you got over $1 trillion debt service, $1 trillion debt service, and 4.4% of your GDP is toward interest payments. Now, I know some of that's going to investors and domestic savers, but some of it's also going to foreign savers, which is kind of a leakage to our economy. So just kind of be aware that the Fed is somewhat trapped.
Yeah, that doesn't bode well for taxes either.
Yeah, what are they going to do,
we're
right?
Going to come up with the money.
Yeah, we're going to come up. Good point, Mike. Okay, so the last thing is how does interest rates affect assets? And Mike said it's going to have some depressing effects on them. So we have, we're going to go back to dimensional funds. We love dimensional funds and their education they put out. This is the growth of wealth over a 16-year period from 1966 to 1982. And I want to show you that during inflation and quantitative tightening, which is the Fed raising interest rates, you can see that the S&P 500 barely kept up with CPI. But some of the other types of assets like value stocks, value index funds did all right. The long-term government bonds, like our buddy here, Mike, said, we don't want to be in them just like they did in the 1960s and 70s.
Right.
So, but how about when inflation breaks?
Wouldn't you agree it's probably the worst holding to have fixed income-wise when you have inflation is a long-term bond?
It's a killer.
Yeah.
I
want to add, these are indexes. They're not actually index funds that we're using. It's just the index data. But I mean, it's pretty relative representation of the actual ETF or fund that you could buy and replicate the asset class.
And overall, like if you take a look,
technical side.
Yeah, that's right. Yeah, we work together, don't we, buddy?
Yeah, yin and yang.
Yin and yang. Yeah. Well, after inflation breaks, this is from 1982 to 2000, 1999. Take a look at like asset classes, or at least indexes, did much better compared to inflation. They went up, in fact, 20x, 15x. And inflation only went up like 2 to 2.5x. So a really great time for investors. So the last thing I want to talk about, folks, is the optimal strategy for you during these inflationary times, these rising rate environments. And there's a couple of things that we have talked about here since we started our show last August, really, and that is volatility is kind of normal.
Sure, right.
And we always kind of...
We're definitely experiencing some.
And we're definitely experiencing some. It doesn't feel good all the time. And what's the best plan for an individual is to look at their risk tolerance, make a plan.
This horse a lot, but I think you have to stick with it. Is you got to have a plan, and you got to stick with it. You have a good plan, and hopefully we're giving people through the different videos good enough information to give a plan. And as I mentioned to you, and I think I'll bring it up again. Mike, you have to stick with the plan because, like Mike Tyson says, everybody has a plan until you get punched in the face. And quite frankly, people are getting punched in the face right now. I mean, it's tough right now. The market's down. We got inflation fears. We're getting punched, but the key is to hang in there.
Well, so we've had eight bear markets since 1980. That the market's been down 20% for over 2 months. But I've had my friends, Mike, and maybe you've had some of your clients call up and say, like, "Hey, what should we do now? I just got punched in the face."
Right.
What do you tell them?
Yeah, actually, I just had a client reach out to me last night and said, what's our plan for the portfolio in a recession? And quite frankly, the plan doesn't change. I mean, you stay diversified, you stay invested, and I know there's a lot of information in the media and the industry as far as telling you, recessionary times, inflationary times, what to be doing and jostling, and it's not a time to be buying or selling your funds, your investments, or to be picking stocks or sectors to be in and out because no one knows the future. And the key is staying diversified and to focus on what you can control, which is take your risk and your need of building willingness to assume risk, keep your costs down, manage your taxes, and diversification. It's your friend. Well, then on the fixed income side, like we mentioned earlier, though, I mean, there is something that you need to be cognizant of. So I think if you have people that have a lot of times I see people when they have a bond portfolio and they have a good portion of the bonds are long-term and or plus high credit risk. And you never want either one of those. And it really starts to show up now in periods like this. That's why you don't want to have those, because when you have inflation kick in, you get equity-like risk with the credit risk, and you get hammered on the long-term bonds just because who's going to want to buy a long-term bond when they can buy a short-term bond with a higher rate?
Yep, for sure. Yeah. For sure. So got a lot of evidence on that. So that's good.
And then
good
enjoy
piece
your
of
life,
wisdom.
right? Focus what's meaningful to you.
Yeah, sure.
Yeah.
And during these times of volatility, folks, it might be a good time to, if you're buying monthly, you're DCAing in, you're buying some at lower prices. So stick to the plan. I mean, we're all getting punched in the face. We were talking earlier before the show that we all have suffered a little bit. We're here in the boat with you. So anyways, if you enjoyed today's content on rising rates and how you should invest during these times of quantitative tightening, please be sure to like and subscribe and feel free to reach out.
QE.
This is Lighter Investor Team signing off. Thanks a lot.